Hey, welcome to the Wealth Initiative. It's the ABCs of investing. I'm Thierry Lenoir. I'm your host, a financial strategist who helps real people find real solutions on building wealth. Most people look at investing, they look at retirement as some big mystery. It's not, it's simply math. We're going to talk about the basics of investing. We're going to start with Ask Terry. This question is from Sarita, a friend of mine in Vacaville, California. Her question was, when investing money in the market, what is the risk and exposure when it comes to losing funds? Great question. Here's the answer. When you look at investing and you look at the possibility of losing money, everyone wants to have some sort of security, some sense of understanding. And when it comes to that, we want to address more so the understanding of how money works and the understanding of investments. That's going to help with the anxiety of possibly losing or growing your money. So when looking at that answer, or when answering that question, remember, you haven't gained or lost any funds until you actually cash out that investment. Now, let me explain. So we have investor A, Alex, investor B, Brian. So investor A, so Alex goes and he's going to invest $100 a month for 6 months. Alex is in what we call a rising market. Alex invests $100 a month. At month one, $10 a share, he gets 10 shares. His share price goes from $10 to $12 to $14. By the 6th month, he's at $20 a share. Alex is happy because the investments are growing, market's going up. And then we take a look at Brian. Brian is investing in what we call a fluctuating market. This market goes at $10 a share, his initial share price, but it goes down. It goes to $7 a share, and then down to $4, and then down to $2. By this time, many people will be panicking. But remember, until Brian decides to cash out, nothing's been gained or lost. Brian's investment in the 5th month goes back up to $7 a share and then ends at $10 a share in the 6th month. So Brian has invested $600. He has 120 shares. Alex has invested $600 and he has 42 shares. 42 shares at $20 a share is $840. And Brian at $10 a share is at $1,260. So again, at the end of the day, you haven't won or lost until you cash out that investment. So now we're going to move forward. We're going to take a look at the plan and the problem individuals face when it comes to really planning or strategizing for investing. A side note, one of the most dangerous things to your ability to invest is debt. And we'll handle that in a later episode, but debt essentially can cripple your ability to invest. But we're going to start with a client of mine. This is a client who 20 plus years ago came to me. We opened up a Roth IRA. We also opened college funds for his 2 sons, and he put $50 a month in each of those IRAs. He's done very well. Last year, this client retired at age 55. He was able to do that because over the years, he had been increasing his investments and growing, and we've been working together. But this story is not about this particular client. It's actually about his son, Tony. Tony, watching his dad, making sure that, he's listening to his dad and his dad's talking about investing and his college funds and things like that. So Tony's pretty excited. Tony turned 18. Tony decided that he wasn't going to go to college. However, he was going to jump right into the workforce. At that time, Tony and his dad consulted me about the college fund, asked about what their options were. We then moved that college fund into a regular investment, an IRA for Tony. Tony jumped in the workforce, and because we had a relationship, now this is a second generation client, Tony jumped around from company to company, but every time he got involved in the company, he would invest in their 401k. He'd make sure he was participating. And so every time he left one of those jobs, we would then roll that money out of that old company into his IRA. Worked great. However, when you don't have a plan, a lot of times I see individuals, that money will sit around. It'll sit there. Sometimes individuals forget about it because it's not a lot. However, collectively, it can add up. So last year, Tony landed his first great job with great income, and he was pretty excited, and he began to invest $500 a month into his Roth IRA. So the beauty of what Tony has right now, he has $130,000. And based on what he has, if he continues to invest over the next 31 years, at that point, he'd be just hitting 60. He'd have $3.1 million. He'd be able to retire, live a great life. So Tony introduced me to his girlfriend, his fiance, who also was pretty excited to hear from Tony what he and his dad had done, how his investments had grown. So we have her started fully funding her Roth IRA. She's pretty excited to understand and have the basics of how money works. Someone typically her age would not have an investment advisor, not have a financial professional that's going to take the time, sit down and explain the basics of how money works, right? The ABCs of investing. And so she's pretty excited to look at Tony and know that they have the opportunity to build generational wealth over their future together. As you can see, Tony has done the right things. He's, on the right path. But let's talk about some statistics of the reality. So right now, there's a stat that says 60% of most individuals cannot handle a $1,000 emergency, right? So if something popped up, it had to be done with cash. 60% of people cannot afford to take care of that. Right now, 25% of individuals that have 401ks have less than $25,000 in that 401k. Again, no plan, no strategy really puts you in a really tough situation when it comes to trying to build wealth. So look, when we talk about making sure that we are on the right path, understanding the ABCs of investing, right? Everyone should have 3 accounts. First account is an emergency fund. Second account is a short-term wealth building account. And then third is your long-term wealth account. This is going to give you the ability to have that money situated and segregated so that you can grow, and you have them separated so that you know what you're using. You got to also be consistent. Time and consistency are extremely important when it comes to building wealth. So Tony had realized that by investing $500 a month over the next 31 years, that's what's going to put that $3 million into play for him. So again, time and consistency, the basics of investing. All right. And now we're going to talk about money truth, right? We're going to dive into the basics of the truth on some of the things that most individuals are confused about. But let's talk real numbers. Let's talk strategy. When it comes to money, a lot of individuals are not sure of what a mutual fund is. A mutual fund basically is a bunch of great companies. You have an individual investor, you have an investment advisor, and then you have that money invested into the global economy. covers all the sectors from consumer goods to entertainment to pharmaceutical to telecommunication technology. What you want to do in a mutual fund is just ensure that your money is diversified. So dollar cost averaging is taking a specific amount and investing. So remember Brian earlier, he invested $100 a month. Even though his share price started to go down and he continued to invest. Share price went back up. He ended up with much more value in his overall portfolio. So again, it was the consistency of investing a specific amount, no matter what happens to the market. Staying consistent is important. And then we talk about compound interest. Albert Einstein called it the eighth wonder of the world. The eighth wonder of the world because money will compound upon itself, creating greater wealth. And this is where time and consistency comes. And so the time value of money comes into play here. And so being consistent, having your money to work for you, compound interest is going to allow you to build that wealth. So remember earlier, we talked about Tony, and at age 60, Tony's going to have $3 million, right? So his fiance didn't want to miss out. She saw what we were doing with Tony, what we had done for his dad, and she did not want to miss out. So look, this is an opportunity to establish and build wealth. Now, she has just started. She's been investing with us for a few months now, but she is on her way to building immense wealth, and she's excited. And so I'm excited to be able to help her. I'm excited to be able to help you. So I have a free book for you. Now, this book essentially can replace me, but not really. But you'll get all the tools and everything that you need. It's called How Money Works. So this book has a ton of information on how to build wealth. Just like this podcast, it's going to give you everything you need to know on building wealth, building generational wealth, and growing from wherever you are, wherever you start today to where you want to be. And make sure that you like, subscribe, and share, right? Get the word out. Build wealth. Join us for our next episode, The Crypto Gamble, how to win in crypto almost every time.